our today's lesson of Advanced Public Finance and Taxation. In today's lesson, we will be discussing the taxation of income of limited companies. The taxation of incomes of limited companies. Now, the first thing to understand is what is a company. A company is a body that is incorporated in Kenya. A company is a body that is incorporated in Kenya, or that is not incorporated in Kenya, but derives its management in Kenya. That's the board of directors have an office in Kenya or sits in Kenya. Now, limited companies in Kenya can either be private or public. They can be either private or public. There are no fundamental differences in taxation of either public or private companies. So that is important to note, that there are no fundamental differences in the taxation of either the public or the private limited companies. In Kenya, the corporation tax rate for a resident company is 30%, while that of a permanent establishment of an unresident is 37%. An unresident company can have a permanent establishment in Kenya by operating a branch. However, different rates apply for the following companies. 1. The newly listed companies. The rules are the companies newly listed on any securities exchange approved under the Capital Markets Authority, that is the CMA, enjoys favorable tax rates. They enjoy favorable tax rates as follows. A. If the company lists at least the following percentages of its issued share capital, the corporate tax rates for specified periods commencing immediately the year of income following the date of such listing are as follows. Now, we have them as follows, and we have them as follows indicated here. We have, if the newly listed companies are listed 20%, the corporation tax rate will be 27%, and this will be enjoyed for a period of 3 years. If the newly listed company has listed 30%, then it will enjoy 25% favorable corporation tax rates for a period of 5 years. If the company has listed 40% of its issued share capital, then it will enjoy a favorable rate of 20% for a period of 5 years. Now, these are the favorable rates for the newly listed companies. Now, why we are giving favorable rates for newly listed companies? This was to encourage the growth of the stock exchange market, where the businesses are improved by having companies newly to list in the stock exchange, where the trading of shares can take place. Now, the other type of companies are the EPZ companies. Now, EPZ means the Export Processing Zone Enterprises companies. So these are the companies operating in Export Processing Zone Enterprises. Now, companies operating within the EPZ have the following benefits. A is a 10-year tax holiday. A 10-year tax holiday, and this is the exemption from corporation tax. So the holiday here means exemption from corporation tax for the first 10 years of business. Then B, a lower rate of corporation tax of 25% for the subsequent 10 years after the 10 years tax holiday. So again, in the next 10 years, it will enjoy another favorable tax rate of 25% in the next 10 years. And afterwards, then it will go to the normal corporation tax rate of 30%. Now, this is illustrated as we have here that the corporate tax rate of companies operating in the EPZ are 0% for the first 10 years, then 25% for the next 10 years, and then 30% afterwards. Now, why are these companies being given favorable rates, the ones operating in EPZ? Now, these favorable rates are to encourage, the growth of the companies that are manufacturing specifically for export. Remember, E here means export. So they are manufacturing purposely for exports. Purposely for exports. Now, when we manufacture purposely for export, and of course we sell these products or we export these products, then we have foreign exchange. The company is able to earn foreign exchange or stimulate the foreign exchange. Now, that stimulation of the foreign exchange helps in the correction of the balance of payment. That one helps in the correction of the balance of payment. Remember, the balance of payment is the difference between the value of the imports versus the value of the exports. And in a number of cases, we have seen whereby the exports, the value of the exports is lower than the value of the imports. What we are exporting has a lower value compared to what we are importing, leading to an imbalance of payment. So stimulating our exports is important because it will help in the correction of the balance of payment. It will help in the correction of the balance of payments. And that's why we are offering the favorable tax rates for the companies operating in the export processing zone enterprises. So these are companies specifically manufacturing for the purpose of exports. Now, the other type of companies are resident companies mining specified minerals. Resident companies mining specified minerals. Now, for the first 4 years of mining operations, income is taxed at a rate of 27.5%. 27.5%, while the normal rate shall apply from the 5th year of the operation. So here we are saying the resident companies mining specified minerals will enjoy a favorable rate of 27.5% for the first 4 tax years. Then later on, that is from the 5th year and afterwards, then it will enjoy, it will be taxed on the normal corporate tax rate, which in this case is the rate of 30%. The rate of 30%. Again, this is for the purpose of stimulating the mining industry. The purpose of this favorable rate is to stimulate the mining industry. Now, that is generally the tax rates that are applicable to various companies that operate in Kenya. So basically, we have looked at the newly listed companies. We have looked at the companies operating in EPZ, that is the Export Processing Zone Enterprises, and the resident companies mining specified minerals in Kenya. Companies mining specified minerals in Kenya. Now, once we have known the corporate tax rates that are applicable in Kenya for different companies, then we need to know how the tax is paid. That is the payment of tax. Now, companies incorporated in Kenya are expected to pay installment tax. They are expected to pay installment tax before the end of the accounting period. Therefore, the amount of tax payable shall be determined at the beginning of the tax year. This amount shall be determined at the beginning of each year by taking 110% of the previous year's tax liability. This is the estimated installment tax of the current year, and we are saying this is 110% based on the previous year's tax liability. Now, what is this 10% that we are putting here? The 10% that we are putting here is an assumption that the business will grow. The income of the business will grow in the current year by an amount of about 10%. So this is the estimated growth, the expected growth in the current year compared to the performance the previous year. So that's why we are adding a 10%. In other words, we are saying the business will not be the same the way it was the previous year. And therefore, it is expected to just grow by, at least, 10%, although it can grow by more than 10%. And therefore, that's why we have the 10% in that estimate. Then, once determined, the installment tax is payable in 4 equal installments. It is payable in 4 equal installments or 2 installments for agricultural companies. So 4 equal installments for normal companies or 2 installments for agricultural companies. Once the company determines the actual tax, that is at the end of the year, then the company, once the company determines the actual tax, the final tax, which is the tax balance in this case, that is the actual tax payable, minus the total installment tax, is payable on the last day of the 4th month of the previous year, or of the following year. It is payable on the last day of the 4th month of the following year. So in this case, the payment schedule for the income tax, that is for the estimated installment tax, in this case will be the first installment, which is of 25% of the estimate. 25% of the estimate is payable on or before the 20th of the 4th month during the year. This is as the year progresses. So we are not paying in the following year, but we are paying in the current year as the year progresses. Then the second installment, which is an equal amount of 25%, is payable on or before the 20th of the 6th month during the year, again as the year progresses. We have the third installment of 25%, which is on or before the 20th day of the 9th month. The fourth one is 25% on or before the 20th day of the 12th of the month. Now, in all these cases, it is important to note that when we are talking about the 4th month, we are not talking about April. When I'm talking about the 6th month, I'm not only referring to June. And in the 9th, I'm not referring only to September. And the 12th month, I'm not only referring to the December. The reason being, some businesses period of accounts are not January, December. And therefore, in that case, when we are talking about the 4th month, it is in relation to when to the accounting period. If the business year, the start of the year is maybe 1st of April, then we have to count the first month is April, May, June, July. So the 4th month will be in July. So it's important to note that we are not talking about specific months like April, like June, like September, like December, because of other businesses whose periods of accounts are not January and December. So basically, that's the schedule for the payment of the installment tax. Then the balance of the tax, which is, of course, the actual minus the estimated, tax is payable. And we are saying here on or before the end of the 4th month after the year end. Again, so it's important here to notice the end. So here we are not using the 20th, but we are saying the end of the 4th month after the year. Then we have specifically said for agricultural companies, then there will be only 2 installments. There will be only 2 installments. That is, the first one will be 75%, quite a huge percentage, 3/4. This is because this is the time when most of the crops are expected to be maturing, and the companies could be now harvesting the produce and selling the produce, and they now have substantial amounts of revenue. They have substantial amount of revenues, so that's why at the same time, the first installment is quite substantial, which is 75%. Then the second installment will be for the remaining amount, which is 25% to make up 100%, and this is on or before the 20th of the 12th of the month during the year. So we have explained here that the 75%, which is quite big, is because this is the time the company is expected to be harvesting and also selling its produce. This is the time it has money and enough money to pay a substantial amount of its tax. So here we cannot ask for the payment of the tax in the 4th month like in the normal companies, because in the 4th month the agricultural companies are busy preparing land. So a lot of expenditure is taking place, busy preparing land, buying inputs, and so on and so forth. Then in the 6th month, maybe there is also a lot of costs being incurred in the weeding or in the weeding processes and also in the spring and all that. So again, it is not convenient to collect any tax in the 6th month. And that's why you can see the bulk of the collection of the tax is coming in the 9th month, and finally the balance in the 25th month. I mean the second installment. The balance is collected in the usual way, just like for the normal businesses. So their balance will be collected in the normal way. That is, the actual tax minus the estimated will be collected by the end of the 4th month during the year. So that is for the agricultural companies. That's for the agricultural companies. Now, for the companies that may be mixing agricultural and other operations, they will be treated for tax purposes to be agricultural companies and pay their installment tax in terms of 2 if 3/4 of the revenue is coming from the agricultural activity. So here I'm emphasizing and saying if a company is doing trading activities, the normal trading activities, and is also engaged in an agricultural activity, and 3/4 of its revenue is coming from the agricultural activity, then the whole of that, the company will pay the whole of its income tax based on 2 installments. The whole of it will be treated as an agricultural company, Then it is important to note that if the company underestimates the installment tax, it will be required to pay a penalty for underestimation.